Hey everyone, and welcome to This Explainer. Today, we are tackling a seriously fascinating concept that completely upends how we traditionally think about commercial real estate. We're going to demystify Safehold. This is a publicly traded company that has pioneered an incredibly unique and historically pretty inaccessible business model, the modern ground lease. So, if you've ever wondered how massive institutional real estate actually gets financed behind the scenes, you are absolutely in for a treat today.
Okay, let's dive right into this. Here is our quick roadmap for today's explainer. First, redefining real estate ownership. Second, the two value components. Third, understanding the risk profile. Fourth, financial health and debt. And finally, sizing the market opportunity.
All right, Section 1, redefining real estate ownership, separating the stack. To truly grasp the genius behind Safehold's strategy, we actually have to unlearn some of the basics of how traditional real estate ownership works. We have to start thinking about properties not as single, unified assets, but as a stack of entirely different components.
At the very heart of all this is the ground lease. Historically, asset classes like ground leases were mostly the domain of universities, churches, or ultra-high net worth families. It wasn't something you or I could easily access. But since its founding back in 2017, Safehold has acted as a true pioneer, bringing this exact structure to the public market. Essentially, what they do is bifurcate the fixed asset, meaning the land, from the operating asset, meaning the building. By doing this, Safehold acts as a crucial gap filler. They provide flexible, non-maturing, low-cost capital to property owners, which makes commercial real estate ownership significantly more capital efficient.
Now, you might be wondering how they actually measure the safety of these investments. Well, that brings us to combined property value, or CPV. This is simply the hypothetical value of both the land and the buildings if no ground lease existed at all, typically estimated by major firms like CBRE. What's brilliant here is that Safehold generally targets a ground lease cost of just 30 to 45% of this total CPV. Think about that. They are putting up less than half the total value of the property, which sets up this massive structural safety net and tremendous long-term upside for their investment.
Which leads us straight into Section 2, the two value components, a tale of two buckets. Now that we've got a handle on the structure, let's look at the core mechanics of how Safehold actually makes its money. It's really best to think about this in a super memorable two-bucket analogy.
On the left side, we have our first bucket, the bond component. This gives them high-grade, highly predictable compounding ground lease payments, and these are secured by diverse institutionally owned real estate in top-tier markets. Then, over on the right side, you've got the capital appreciation bucket, or what Safehold calls carrot. This represents the future ownership rights of the property above their initial cost basis. It is essentially a long-term call option at a steep discount. It requires absolutely no additional capital or operating requirements, and it is highly tax-advantaged.
Let's look a little closer at that carrot bucket, because the long-term multiplier effect here is just wild. Because Safehold owns the underlying land, when a 99-year lease eventually expires, the ownership of the actual buildings on that land reverts right back to them. That creates the potential to return roughly 20 to 40 times their original investment basis. That's a massive multiplier. And the best part? While you wait for that long-term payoff, the bond component's periodic CPI lookbacks are steadily capturing inflation, which protects the real value of their cash flows in the meantime.
Of course, potential rewards mean absolutely nothing if the foundation isn't secure. So let's shift gears to Section 3, understanding the risk profile, visualizing the stack.
Let's methodically break down the last dollar risk. Take a look at standard equity REITs. They have an asset attachment point of 100%, meaning they are bearing full equity risk. When you factor in corporate leverage, their creditor look-through loan-to-value, or LTV, sits right around 75%. Mortgage REITs carry a somewhat lower attachment point, sure, but they still yield a 53% look-through LTV. But look at Safehold, way down at the bottom. Because they only finance that foundational 30 to 45% of the property we just talked about, they sit safely at the very bottom of the risk stack. Even when you factor in 66% corporate leverage, their creditor look-through LTV is a remarkably low 27%. It is pure fixed income risk.
That extraordinarily low risk profile on the asset side perfectly transitions us into examining Safehold's own balance sheet. Let's look at Section 4, Financial Health and Debt, built to last. We need to see exactly how they finance these unique assets to ensure the company can actually go the distance.
Right off the bat, Safehold operates with an A-rated debt structure, which gives them a frankly massive competitive advantage. They have successfully locked in their permanent debt for literally decades. In fact, looking at this chart, 52% of their permanent debt doesn't even mature until 2049 and beyond. Overall, they boast a phenomenal 18-year weighted average maturity with absolutely zero near-term maturities to worry about. They have secured billions in capital at an effective interest rate of just 4.3%. They are essentially locking in their margins for an entire generation.
And on top of that, their balance sheet is fortified by some serious liquidity. Standing right alongside their $5 billion in total debt and a very reasonable 2.0 times corporate leverage, Safehold maintains $1.4 billion in pure liquidity. This dry powder means they aren't just sitting around playing defense, they are primed and ready to capitalize on new, attractive ground lease opportunities. The second capital events, like a buy, sell, recapitalization, or new development, pop up in the market.
We spent a good amount of time on the micro mechanics now, so let's zoom out. Section 5, Sizing the Market Opportunity. Micro to macro. Let's see just how big this could get.
First, let's put some context around exactly where they are today, $7.1 billion. That is the staggering current size of Safehold's ground lease portfolio. Just to put that into perspective for a second, at their IPO back in 2017, this portfolio was a mere $300 million. Thanks to their highly dedicated originations team and growing brand equity, they have scaled this thing nationally at an absolute blistering pace.
But now, contrast their $7.1 billion portfolio with this completely mind-boggling number, $7 trillion. That is the total estimated value of the U.S. institutional quality commercial real estate market. Safehold is the first and really the only nationally scaled, publicly traded ground lease platform swimming in this ocean. The sheer runway they have to continue separating land from buildings and unlocking value is honestly hard to overstate.
Of course, they aren't just out there buying land indiscriminately. They filter that huge $7 trillion ocean through some incredibly disciplined investment criteria. They exclusively target the top 30 U.S. metropolitan statistical areas with the strongest fundamentals. They strictly demand that low 30 to 45% ground lease to value metric, and they require the property's net operating income to safely cover the ground rent by anywhere from 2 to 4.5 times. Plus, they're working across all sorts of types: multifamily, office, hotel, mixed use, life sciences. Remarkably, their model even acts as a gap filler to reduce subsidy requirements and push forward really vital affordable housing developments under the low-income housing tax credit program.
So when you step back and pull all of this together, you see an incredibly elegant solution. Safehold provides a highly aligned, highly transparent model that genuinely benefits property owners with low-cost, flexible capital, and at the exact same time, it provides their own investors with high-grade, compounding cash flows and massive residual upside. They didn't just enter a market, they structurally modernized and scaled it from the ground up.
Which leaves us with this final, incredibly provocative question to ponder today. If bifurcating the land from the building completely redefines the risk stack, unlocks stranded equity, and creates such highly efficient capital for top sponsors, why aren't all institutional commercial properties built on a modern ground lease? As Safehold continues to educate the market and scale its $7.1 billion portfolio against the $7 trillion ocean of opportunity, the fundamental mechanics of real estate ownership may never be the same. Thank you so much for joining me on this explainer, and definitely keep your eyes on how this fascinating space continues to evolve.